Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Lynn & Associates with your agriculture update for this Monday, the 3rd of April, 2017, about 2:10 p.m. Central Daylight Time. Well, the event of the day is continuing to be the acreage questions that the USDA gave us on Friday. I read a lot of reports over the weekend, and people still think that you're going to take more acreage out of the corn market and put it into the soybean market than the USDA gave us. In the cotton market, what was deemed favorable on Friday for cotton, and they were looking at just acreage, what's being planted, so on and so forth, got a big reversal today. It's a heck of a break, almost 3 cents, about 2 3/4 cents. Heck of a break in that market. And we just keep looking at the wheat market, sort of trying to follow what everything else is doing. We're getting a bit of a bounce today in the dollar. A decline in stock indices, but they are coming back in the late afternoon. Take a look. They're all coming off their lows. So that's impressive. Keeping that market down, very, very difficult as time is going on. We know that President Trump is meeting with the Chinese premier this weekend at Mar-a-Lago, and we'll find out how trade goes with that. Are we looking at areas that are going to hurt or benefit? And that's what we're all going to be waiting to see. In the soybean market, you've now gone from 1080 on the weekly chart that was made right into mid-January down to 937 1/4 is the low, and you closed only a penny off the lows of this deep break that the market's had. So we've had a break of about $1, what is that, almost $1.43 or so. Quite a sizable break that the market has seen. And as you take a look on a close-only chart, you've really come down now over $1 there as well. So this is just a continuing move to the downside. What will probably end this decline will be once the plantings get underway, too wet, too dry, hot summer, whatever it is, that's when we'll see if the market has a bounce in it. As you take a look at the daily bar chart, it's just leaking away in price. So what's going on and has been going on is a lot of hedging in this market. It's a game of, hey, I don't want to own the crop. You own the crop. I don't want it. And the next guy keeps dumping it because as prices keep eroding, holding that crop in storage doesn't do you the greatest thing in the world. In the soybean swing line, you've got a pattern of lower highs, lower lows. That is bearish. The market is also trading under the 18-day average of closes. That is bearish. I'm going to be looking for this number very quickly to get up near this 976 zone where I'm suspecting will be the resistance point if the market can get a bounce even into that zone. But that's what I'm looking to occur. When I look at prices today, you now have 2 days in a row where settlements are under the lower Bollinger Band. Now, 5% of the time is the theory that the market will trade under or above these black dashed lines that are called Bollinger Bands. You can take that, and what I've done in my studies is I've gone to see how many times the market's done 5, 7, and 9. And I've gone back a lot. 9 is very, very rare. It can happen, but the amount that it can happen of isn't worth even discussing, but I've done the study. 7 can happen on markets that really get an overwhelming, be it bearish or bullish bias to them, and some event happens. Under a more normal set of conditions, 5 is about it, and what I do is I target each one of these days that it's under it as one of those 5%. So now I can make my argument, doesn't mean I'm right, but my argument, 3% of the time will the market stay tomorrow under the lower Bollinger Band. Got it? This is also called very bearish action because it's what you call riding the lower Bollinger Band, and when you combine it with an embedded stochastic, it's just a son of a gun. It also means that rallies right now should not be as strong as people think. They'll probably be more feeble when that occurs. In the May meal, it's the same thing. You're riding the lower Bollinger Band. Today you did close over it. You close 307.60 over a 307.30, so it's just classic riding it, not even giving you a chance to get short, and it's got the embedded reading. Soybean oil being taken for the ride with the rest of the markets, closed right over the lower Bollinger Band, but very oversold. This has not been the play to be short. The play has been the beans and the meal market. In the corn market, we had more of a rally, and for those of you that get my twice daily information and get to see my morning subscriber video, that's not these. Those are for my subscribers only. I kept saying this morning that I think the 369 and 3/4, 370 area is where the hedgers are going to start coming in on this market. Now, you can extrapolate that to further back months, don't get me wrong, but once you get up to that upper Bollinger Band, that's where I think they're coming in, and it's pretty much what occurred. What is the trend now? Well, it's trendless. You got a lower low, you got a higher high, you have a market that might decide to balance itself out, something between the 100-day average and the 18. We'll see if the market can stay again over that number, but with Tuesday tomorrow, it's subject to a Tuesday reversal after a strong 2-day rally. In the wheat market, you can just see the market's failing against the 18-day average. It tried to extend itself to the 100, couldn't do that. It is no longer embedded, which means prices should have gone towards the closest of the 18 or the 100-day average, and it made its run to the 18. So I now see a market that needs to rebalance itself. The sugar market's bottomless. I wish I could tell you where this market could bottom out. It rallies just enough every now and then to knock you out of your short position, especially when you get this pattern where the swing line turns back up. But this 18-day average is a rather formidable line in the sand, and now it's riding the lower Bollinger Band. Tomorrow, if it closes down on the day without a big reversal, you could get another embedded reading in it, and that means the rallies are going to be sold again by the pros. Coffee, a major price failure today. Now let me show you what I mean by this. This was Friday's action. You're under the 18-day average. You have a marketplace that is oversold with readings at 29 and 29.94. So they're basically looking to see what it can do. Today the market gets a big time rally up to 142.80, and by the end of the day it gives that whole thing back. It had a 500-point drop from there. That's a heck of a move in one day, and it's probably on line to challenge the lower Bollinger Band, but it is oversold. In the cocoa market, the argument's going to be, can it get any legs to the upside here? Momentum is pointing down. Price is trying to point up. Here's what I think could happen. Wouldn't surprise me if the pros try to buy on a pullback to 20.78, but I think they'll bail with both hands and reverse to the short side if you take out 20.60, today's lows, the low of an outside day up. That's what I think. Doesn't mean I'm right on it, by the way, and it's not a trade recommendation. But where's the battleground? The 18-day average. If you can extend up from here, 21.71, the 100-day average does come into play. I'd like to see momentum, though, not point down. A monster failure in the cotton today. From 78.07 to 75.44, made a big run up over the 18-day average, ran into that barrier, couldn't stay over it, and bang, right on back down to the lower Bollinger Band, and look at how oversold you're getting in the process. In the cattle market, what you've done is what I predicted. When the market lost its embedded reading right over here, this day, that means price and the 18-day average should, doesn't mean they have to, but should make a run at each other. Market didn't do it for a number of days. Then it began it on Thursday, went down to it on Friday, again down to it. So you're at that point where now the market's got to rebuild itself. You've got the swing line down, but price is over the 18-day average. And given the size of the break, I'm not saying you can't get bearish if you close under that 18-day average, but you'd have given up already 500 points, which is a lot. In the feeder cattle, you haven't gotten to that 18-day average. You've missed it. You made a run towards it. I'll give the market the credit, but often it hits it. I don't see a buy signal because the swing line's down, price is over the 18-day average, and if you believe, as I do, that momentum leads price, it is still pointing down. In the hog market, got up just high enough to take out the previous swing line high, And now all of a sudden you got a huge outside day down. This market looks sick, sick, sick. And guess what? This was your bearish crossover day on Friday. Do you see that? The 18-day finishes under that number. Today you're getting that break from when that occurs. That's part of what I teach and what goes on. And speaking of what I teach, a lot of you took advantage over the weekend. On one of my videos, I put my charting course. Can't believe how many people did buy it. I was very, very happy to see that. You know, this is a course that it's evolved over other courses that I've done over the years, probably 2-3 generations of me. I'm talking tens of years, so 25 years of doing courses in different ways, you know, CDs, DVDs, live chat rooms, people coming in. I teach it, rent out a room in a hotel. Well, I've redone the course as the years have gone on, and I've modified it for high-frequency trading and the like. The course at one point was costing almost $500 from me. Then I lowered it with technology to an average of about $200. I redid the course again at the end of 2016, had it ready for this Christmas, and I started it out as a Christmas special at $69.95. And now I've had price increases. I'm up to $89.95, and I'm telling you, I'm going to kick the price up even more. I'm offering you right now a discount of $15 if you type in Ira 15. It's that simple. Doesn't have to be all caps or anything, just Ira 15, all one word, when you go to get it. I'm going to teach you slow stochastics. It's 54 chapters, 54 video chapters, each about 8 minutes long. You get the charting software you need with it, $99 value roughly. You get my twice daily updates, access to my subscriber video, a $60 value, and then the course itself, all with the discount for $74.95. No shipping, no handling. You might want to take serious advantage of it. You get an awful lot. This is what the course video will look like in the mornings. About 9 o'clock, I post that. So if you'd like more information or you'd like to get it, you can either call us, go to our website under the word education. You'll see all the information about the course, including a small video that I made about it. Or you can click right up here. If you do that, it'll take you right to the landing page for the course, and you can see all the questions answered there. I'm Ira Epstein. You have a great day, and I'll see you tomorrow.